Good morning. Hopefully everyone will stay around for the next session because it's going to be great. It's great to be back in Miami, and it's fantastic to see so many people here. Unfortunately, I missed last year's event because I got COVID the day before I was meant to fly out, so super pumped to be here. You can really feel a lot of the energy throughout the city. So our next panel sets out to answer a key question for allocators as they build out their alternative asset exposure in 2023. Is emerging manager alpha still compelling? I think certainly with the outperformance by some of the larger hedge funds last year, the question couldn't be more relevant. So please welcome to the stage our moderator, Linda Liu, principal at the Blackstone Group, and a deal team member on their seeding business, the Strategic Alliance Funds, and the four panelists. Paul Markison, lead portfolio manager, head of New York at Norges Investment Bank. Lionel Erdely, co-CEO and CIO at Investcorp Tages. Jan Kavicko, managing director, external portfolio management at CPP Investments. And Chris Winiars, CIO at Stable.
All right, good morning, everyone. Thank you for joining us. It is certainly an exciting time as ever for emerging managers, so I am absolutely honored to have with me here on stage among the most well-respected investors in emerging managers. And between these four guys, they've seen it all and done it all. So without further ado, let's hop right into it. So guys, can you comment on what your approach is to emerging manager investing? More specifically, in what asset classes do you play? And to the extent that your organization has different pools of capital with different objectives, do you do seeding economics? Do you do day one allocations with discounted fees? How does that all work? Lionel, I'm going to kick it off with you.
Thank you, and pleasure to be here today. We've been investing in emerging managers for 25 years. So of course, we've done a lot of sectors, a lot of geographies, partnerships, with the managers. I would say the common denominator has always been the search for alpha, regardless of the geography or the sector. We have deployed capital in more than 120 managers day one over the 25 years plus, and done more than 40 partnerships on the seeding side. So we have various pools of capital, but very often when we engage with emerging managers, we don't really know if it's a day one investment. The priority is really to help the managers design their firm, their investment process to generate superior returns. And after, we can help them and so on. But we've been a very early believer and continue to be a strong believer in the talent and the performance potential of emerging managers.
Got it. Jan, what about you? How does it work for you at CPP?
Yeah, so at CPP Investments, we've been investing in emerging managers as well for a long time. The program focuses on public market strategies and very much alpha focused as well, looking for uncorrelated returns. We focus on forming long-term partnerships with a smaller set of managers that we look to scale to a very meaningful size for our portfolio. So we've probably done a total of 15 deals or so across seeding and what we call capital acceleration. And some of those have become multi-billion-dollar managers where we are, a third or in some cases more of the assets. So that's really the motivation, is to add alpha to the portfolio, get attractive terms and capacity rights, and look for long-term partners.
Got it. Thank you. Paul, what about you?
Yeah, so we're a little bit more focused on equities. So we do fundamental equities, a lot of niche strategies, also very focused on early stage emerging managers. I've been doing that for a long time. Like Lionel, we've been doing it for 25 years. And a huge chunk of our returns actually come from emerging managers through the years. So yeah, unlike some of the others that take stakes, we are very much sort of like a day one investor or day two investor. We are the people that come in, bring people from 50 million in assets to 200 million in assets. And that's the setting.
Awesome. And then last but not least, Chris.
Sure. Yeah. So all we do is exclusively emerging managers. So we back founders, typically day 0, 1, or 2, 0 incubation, warehousing. Day 1 is literally day 1, or day 2, some form of acceleration. We manage across all asset classes. So I think we've now backed 26 founders since our inception across hedge funds, private equity, venture capital, private credit. We have a little bit of a different model where we roll out an old school VC operating partner model and help these firms on the operations and the distribution side to grow and scale their businesses. So really providing that seed and that growth capital to help them scale their businesses.
Great. Lionel, I want to go back to you. You're at a vantage point where you invest across established managers and emerging managers. Can you comment on the value add of emerging managers in your own portfolio and in the industry more broadly, particularly after a very challenging 2022?
Yeah, that's a great question, because 1 year ago, when we were here actually discussing this, it was the end of a period where emerging managers significantly outperformed. You remember 2020, 8% outperformance of equally weighted versus asset weighted. Last year, the same. Previous year, the same. And 2022, it has been really the performance of big hedge funds. So we tend to look at a more long-term horizon. But just on the 3 consecutive years I just outlined, which were each of them unprecedented, still emerging managers have outperformed, you know. And I think what's interesting is to try to quantify the risk premium in emerging managers and identify the risk, because our experience over 25 years, but also when we look at industry databases, is that there is a very interesting risk premium. You can quantify it around 2.5% perhaps in investing early and in smaller firms. But there is also a higher risk, obviously, and volatility would be probably 1.5%. So our experience is that the challenge of monetizing this risk premium or harvesting the risk premium, it's about the left tail. Because the range of outcomes when you invest in emerging managers is much wider than when you invest in established managers. So there is a very high level of dispersion. But if you've tried to mitigate and you manage to mitigate significant risks and protect the left tail, as I said, actually you will have a better alpha, you will have a better diversification and superior returns. That has been our experience, but it requires a lot of work. For your clients, of course, it's a lot of explanation, a lot of transparency. That's sometimes a beautiful challenge, but we strongly believe in it. We are very excited to help managers grow as well. And when you look at the seeding component, where we really help our partners, our manager partners grow, there is no doubt you have a very significant outperformance versus a traditional portfolio of established managers. That has been our experience, but it's all about, again, managing the risks, having the right liquidity structure, and so on. The risk of failure is still there. You know, you have 10% of managers who disappear. You know, you take every vintage and 10% you have an attrition approximately, so you need to deal with that.
Got it. We'll come back to that point, but in the interim, Jan, CPP has a large external managers program across established and emerging managers as well. Can you comment on the outperformance of any of the emerging managers in your book?
Yeah, so I think we've seen emerging managers in our book overall perform strongly in line with our expectations. We've also seen our established managers also perform well. I think what we are looking for with the emerging managers, though, is definitely capacity, because our portfolio continues to grow. And so sometimes we are not able to add or further grow our established manager relationships, especially in more capacity-constrained strategies. And then, of course, we also look for attractive terms and lower fees, which we can get either through discounts for being early or revenue share in the case of upside business growth. And so I think we've generally seen performance, you know, along those dimensions in line with what we've set out, you know, more than 5 years ago.
Great. So as we look forward, can you each talk about what your priorities are? And as you think about the industry trends out there, such as DEI, ESG, big data, how does that factor into how you partner with the next generation of talent? I'm going to start on the other end on this. So Chris, that means you're first.
Yeah, I think there's probably 2 things that are a focus for us. One is we only focus on inefficient markets, really where there's a specialist required to execute the strategy. And that's a combination of reasons. One is that's where we think the alpha is created. And two, I think just commercially, that's where the incremental dollar is going. We don't see a lot of institutional asset allocators allocating to another middle market buyout shop or another US equity long short business. So I think for a variety of reasons, we focus specifically on specialists and inefficiencies. And then the second, which has been a big push for us, is we focus on cognitive diversity, which is maybe a little bit different than the traditional industry definition. And when we think of the types of men and women that we're trying to back, there's really a couple skill sets. One is the ability to overcome adversity, and the other is, as an investor, to be a great contrarian thinker, being comfortable being different. And it just so happens there's some research and data that really supports this, that being different or being comfortable being different and overcoming adversity are very consistent with cognitive diversity. And so that's not just gender or race. It could be sexual orientation. It could be socioeconomic background. It could be losing a parent early in life. And so for us, that's really the input, is cognitive diversity, and that kind of shows through the numbers.
Got it. On that point, how do you evaluate that?
Yeah, so it's spending a lot of time with them, their significant others, their family, their friends, getting to know who they are as individuals. We spend a lot of time trying to understand their life story and how they've gotten to this point. So it's not just tell us about the strategy, but it's tell us about who you are as a person.
Great. Paul, what about you? Where are your priorities?
So I spent a lot of time focusing on Europe So doing a lot of Europe and then some niche strategies. So looking for a South Korean small cap manager if there's someone out there, and various smaller sectors out there. We're very much sort of fundamental bottom-up driven. That doesn't mean that this new data tools, data science doesn't play a role. And it's becoming table stakes to do some data scraping, follow some alternative data. So that's important for everyone, but we don't specifically look for that as the sort of the sole determinant. A lot of our time is spent meeting with managers, talking to them, understanding how their models are put together, their assumptions. There's more fiction written in Excel than Word. The key thing is what is the inputs in the Excel model, right? So we spend a lot of time with the managers trying to figure out how do they come to those things. This is a very easy business, but it's very hard at the same time. And you just have to put in the legwork and to find the answers.
That makes sense. Jan, what about you? Where are your priorities?
Well, for us, we always try to find the best new talent out there across all strategies. I think probably one area that we're prioritizing is just being a bit earlier stage, having discussions with potential managers and PMs sort of very early in the process as they're still thinking about how to form their business, how to grow their strategy, how to, various aspects of their business. And that's something that we've had some success on in terms of, identifying people early. And we've also been focusing as well on what more can we do to help our managers. I think our capital is very helpful from multiple angles, whether it's making sure that managers can get the best talent on their team because of the longevity of our capital and the size, but also thinking whether we can help more directly in other areas like operations, which we already do quite a lot in terms of establishing managers' ability to undergo very rigorous diligence processes of other institutional clients, but looking for ways to do even more in all of these areas.
Got it. And Lionel, finally, what about you?
Two sets of priorities, I would say, because like Jan just mentioned, we are focusing really on trying to find the best talent, regardless of the sector. But our clients actually have asked us to focus a bit more on macro and CTAs. So we've spent a little bit more time on this. We are strong believers that there is a great opportunity opening up on structured credit, and that's an area where you don't have so many launches, and it's important to launch at the right time because it can be a dislocated market. So we've spent a little bit more time there. And in terms of trying to help our managers, our partners grow, it's really continuing to strengthen the business development team, because we really dedicate resources to help our managers grow on the seeding side in particular. So we have continuing to spend time and efforts on trying to find the best talent there.
So that's a good segue, actually. If we take it one step forward, and these emerging managers are lucky enough to get a ticket from your organization, what can they expect from a partnership with you? What does it look like? So Lionel,
Okay.
you're first.
So as I said, we invest day one, and we invest also as a seed partner. And of course, our engagement varies depending on the nature of the investment. For a day one investment or emerging manager, it's really trying to be a long-term partner, you know, I mean, be aligned with them. We are patient investors. It's helping them navigating tough times, because it's difficult to manage a portfolio and launch a business. And it's really sharing our experience as with a bit of a partner mindset, even if, of course, we are investor. But that's what I would say for the emerging manager investment. On the seeding side, of course, we have a very limited number of investments we make. We are very exclusive, and we want to give the best, because it's very important to be successful during the first 3 years. You know, it's a path-dependent road to success. And we provide distribution, which is really something we spent a lot of time on, because we know the investor community, and we try to protect the time of our managers. One of the big help, I think, is we tell them, you focus on your portfolio, we take care of distribution, and you're not distracted. So that's really, and of course, advise risk management systems. And if people want to join us also in-house, that's something we have developed more recently.
Got it. And Chris, you alluded to this a little earlier, but what can one expect from a partnership with Stable?
Yeah, so I think the first thing that everyone is looking for really is capital. So in our instance, we can provide strategic capital, seed capital, be flexible with that solution. But ultimately, it's about the relationship and bringing them into the founder network. And so within that construct, we've got an operating partner platform where we can support on the operations and the distribution side. Our goal is to make these firms independent, sustainable in their own right, not necessarily do things for them, but more of a teach a man or woman to fish approach. And so that ranges from talent management and recruitment to prime brokerage, ISDA negotiations, all the way to branding, product design, competitive positioning. It really spans the gamut.
Got it. Let's now transition over to notable topics in the news and the latest and greatest developments in the emerging manager landscape. So we might have read that new launches are at a 14-year low. Paul, I want to go to you for this one. Any reactions to that? Should these emerging managers out there just give up?
I hope not. That would be tough for business. No, I think this is a period in time. We came out of COVID. It's been tough to introduce a new fund to new people. And sure, there's some structural changes going on with the growth of the multi-manager platforms, et cetera, which is putting some damper on stealing some talent away from launching your own fund. But there's clearly room for new emerging managers. I think it's just hard work. Starting your own company is not easy. You have to be willing to meet clients, do marketing, and in addition to investing. So there's room.
If I could add to that,
Yeah.
We conducted a bit of research on that and noticed it's actually quite cyclical. So the data supports that about 70% of hedge fund founders really started in times of dislocation or stress. In our paper Project Legends, it really forces us to look for these periods of opportunity when the most talented investors are waiting and buying their time to start their new firm. So we think it's actually quite cyclical. COVID just put it on pause for a little bit, and now we're seeing a ton of talent.
So some might attribute the lull in the new launches to what Paul had spoken about before, which is the proliferation and the growth of multi-manager platforms, which has potentially become an increasing source of competition out there for talent. Jan, do you have any views on this? How do you think this dynamic impacts the emerging manager space? How does it impact your business?
Sure, I think the multi-manager platforms have been a very effective structure for investors to gain access to hedge funds. But that being said, we think there is still quite a lot of room for multi-strategy managers, single strategy managers, and the like. And we have not slowed our pace of capital deployment in emerging managers. We do find that people now have more options when they're launching. They can join a platform, they can raise SMAs, they can get a seed deal, which is good, I think, for the space and good for PMs. I think we'll continue to see that going forward. The current opportunity set for hedge funds seems rather attractive at the moment, so that's always supportive for new launches if it's slightly easier to generate those returns. That then attracts the capital. And then we've also, I think, seen some inflows as well into the more interesting strategies. So I think it's actually as good a time as any now for new launches.
I couldn't agree more. Let's now transition over to advice. If you were to leave emerging managers here with a piece of advice, any do's and don'ts, what would that be? Lionel, you're first on this.
I would say stay focused. We've seen a lot of talent failing because of the distraction of launching a business. Most of the managers, of course, don't have the experience to launch a business. So to stay focused, you need to have the right team around you. You need to have a strong partner on the operation side. You need a strong devil's advocate to challenge you and to protect the firm. So the focus is really what we've seen missing. And to my earlier point, Linda, when I was saying we try to help our managers really grow their business with our support, because we've seen too many managers, especially on the fundamental side. It's less true for systematic side, but for the managers on the fundamental side, you spend a lot of time with clients, you fall in love with positions, you just launched your business, and if you're wrong, you kind of feel it's difficult to change your mind, and you should not. So it's about being focused and about having the serenity also to have time, to know that you cannot be performing every quarter, but to manage the strengths with a very strong resilience and serenity. And that's really something where a partner like all of us here, on this panel, I think have experience. It's difficult to launch a fund, even if you're talented. It's difficult to launch a business. I have tremendous respect for the people who do that. But you need focus, you need serenity, and you need the right people around you.
Perfect. Jan, what about you? Piece of advice.
Yeah, so for us specifically, definitely one thing is to be as early as possible in approaching us. So whenever there's an idea to start a business, it's always useful to have a conversation, reach out to someone on our team, and then we can provide advice or our thoughts on how a new business might look or how it might be positioned in the market, how we would look to partner with it. I think another thing is to be very transparent as well in the discussions with your early stage investors, because ultimately we will all find out all of the sort of flaws and issues in your background, and the more upfront and transparent that you are about those, I think that's also really helpful.
Perfect. Paul, what about you?
Yeah, couple of things. We see a lot of pitches from managers that launching, right? The whole story of I do the same thing as everyone else, just better, doesn't really sell. So come up with a slightly better pitch than that, right? Just waiting to collect 3 years of performance record and assume that the money flows in doesn't work. You have to get out there and raise the money. And finally, I think try to get a diversified pool of clients from different kind of settings. There might be some fund of funds, there might be some family money, might be some sovereign wealth funds, but diversify your client base, because eventually someone's going to pull out their money and you don't want to be stuck with just one client.
Perfect. And Chris, finally.
Yeah, some similar thoughts. I think for us it's about building a business and recognition that the world does not revolve around the portfolio manager. And that means it's a three-legged stool, operational infrastructure, distribution, investment management talent. And so making sure that people are mindful of the other parts of their business, that you are building a business, you're not just running a fund. And particularly as you grow and become a more institutional, acceptable mandate, the talent on the stage is going to look for those sorts of things. So just be mindful of it day one.
That makes a lot of sense. So we're running out of time here. I want to end it on a speed round with these guys so that the audience can get to know our panelists a little bit better. So guys, for this part of the panel, there are going to be a series of questions. Don't think too much into it. Just say the first thing that comes to mind. All right? Chris, I'm going to start with you. If you were to have brunch with one famous person, who would that be?
Famous person. Probably Rich Handler, who was on the prior panel.
All right,
He's
got
built
it.
a great business with Jeffries.
And Paul, if you were to have an unlimited supply of anything in life, what would that be?
Unlimited supply. I guess money would be it.
All right, Jan, this is a would you rather. Would you rather be able to see 10 minutes into the future or 10 years into the future?
10 years.
10 years, all right. Lionel, what is something that nobody knows about you here? Fun fact.
I mean, the fact that I'm American, I have a great fake French accent.
All right, and we're going to go down the line on this because this is important. Chris, beverage of choice.
Snapple iced tea.
Snapple iced tea. All right, Paul.
Coca-Cola.
Coca-Cola. Jan.
More recently, it's been chamomile tea because I've been having too much coffee.
And then Lionel, beverage of choice.
Yeah, cinnamon, tea with cinnamon because I heard it's good to lose weight. So I'm adding cinnamon to,
All right,
and cloves, by the way.
Got it.
That's
So
my
with
advice.
that, you know what to get these gentlemen during the day during networking hour. So thank you to iConnections for having us, and thank you to our wonderful panelists for your thoughts and insights.
Thank you.